All right, so we are standing in the way of either Red Hook cocktails or traffic on the BQE, whichever you're most interested in. So we will make this as exciting as possible. I'm David Pakman from Coin Fund, and we're going to talk a little bit about building crypto companies in the US. We are crypto native investors, invest in a whole bunch of different crypto companies. Two of them are on this stage. I wish I was invested in all three of them. They're all three great companies. But we're going to talk about building in the US. We're going to talk a lot about DeFi stuff as well, because we got a lot of folks who know an awful lot about and sit in the intersection of mainstream usage and DeFi. So let's just run down the row here. Sun, why don't we start with you? Just really quickly who you are and your company.
Hello. Oh, it works. Hey everyone, I'm Sun. I'm co-founder and CEO of Veda. Veda is the leading vault platform in DeFi. We're about 14 months old. We've grown to over $3.5 billion in TVL. Recently announced our Series A, led by Coin Fund. So excited to be here. Also, really great partners with EtherFi. So yeah, happy to be up here talking amongst friends.
Mike.
Hi everyone, my name is Mike Silagadze. I'm founder and CEO of EtherFi. What EtherFi is building is a crypto native DeFi bank that is an end-to-end alternative to a traditional bank. You could think of it as a crypto native neobank. We started off with our first product, I guess about 1.5 years ago, called EtherFi Stake, which now has about $6.5 billion in TVL. And then we expanded into this kind of broader offering. Now that's already one of the largest card and infrastructure fintech programs out there.
And Roshan.
Thank you, David. I'm Roshan. I'm the CEO of OKX US. We are one of the oldest crypto exchanges in the world, and we recently launched in the US.
Okay, so let's talk about building in the US. Mike, I want to start with you because you've got an interesting journey, and you had to do. You've been at it long enough that you were formed in a time period where you'd be crazy to be a software developer doing Web3 stuff in the US. So will you share a little bit about EtherFi's journey? How did you decide where to start the company? What was sort of your calculus, and what's the current state?
Yeah, I think that's an accurate way of putting it. We initially, we started and are still based in Cayman, in the Cayman Islands. Physically, actually living based there. We've got an office with 15 people in Cayman. And one of the reasons we did that was, I mean, there are a lot of advantages of being based in Cayman, but one of the reasons was regulatory uncertainty in the US. With the regime change that recently took place, we felt a lot more comfortable, and in fact ended up getting a legal opinion that the coast was clear, at least for things like the staking product and our card product. And so then we kind of decided to enter the US market, and we're seeing a ton of growth here. All
right, so just for clarity, you're a US citizen, right?
Canadian citizen.
Canadian citizen, North American citizen, okay. But you have US employees, US citizen employees, and you decided the best advice at the time was headquarter the company outside the United States in the Caymans, still based there, but also you geofenced a bunch of different territories when you launched, didn't you? Can you talk about that?
Yeah, that's correct. So that's what I mean that our staking product wasn't, or the card product wasn't available in the US, is we had geofencing and a bunch of other protections in place to try and prevent Americans from using the product. But then, at some point, the risk we felt was low enough that we lifted that.
So are all EtherFi products available to US-based users right now, or what's left to come?
No, I mean, especially when you're dealing with the last mile of TradFi rails for like our card product and a few other aspects of it, like the fiat off-ramp. It is very, very, very jurisdiction specific, down to individual states. So depending on the state, all states are blocked from our liquid product, which is the DeFi strategy vault that we work with Veda on. So that's not available in the US. But on a state-by-state basis, the card program is not available to some states. So we spend a lot of money on lawyers, and probably will continue to do so.
Roshan, tell us a little bit about OKX's physical journey, locations and territories, and then also where the exchange is made available, which users can use it.
Sure. So, like I said, OKX is one of the oldest cryptocurrency exchanges in the world, going back to 10, 12 years. We operate out of all the major continents in the world. We have operations in Southeast Asia, in Asia. We have an office in Singapore, in Hong Kong. We operate out of Dubai. We are regulated in Dubai, in Europe. We are in the process of getting a license in the UK as well. And in the US, we have licenses to operate in over 48 states. We don't have New York as yet. We currently launched our spot exchange the last month in the US.
Can you talk a little bit about the journey to seeking those state-by-state licenses and how long that took?
Yes, so there's a little bit of history there. We started the process of getting those licenses a few years back, but we did not formally launch here in the US. When we finally decided to launch in the US, it was probably a year and a half ago. I joined the firm nearly a year ago, and we started the build. Launching in the US the decision framework is multi-layered and pretty complex. So you start at the top. We looked at the top level. You look at the opportunity sets. So in the US, we saw 4 different opportunity sets in the US. You have the spot market, an ever-expanding spot market of digital assets. And then as that spot market expands, we see that window of opportunity to get into derivatives, which, I assume that derivatives market will grow over time. The third opportunity set is, the RWA space. So, we build markets in public blockchains, and as more and more RWAs get into blockchains, I think we can play a role in distributing those assets as well. And the fourth opportunity set that we saw was, interestingly, this convergence between payments and stablecoins. So, those were at the top level, the opportunity sets that we saw. And that's the reason why we started to sort of really build out the architecture needed for building the franchise in the US. Now, you take that one step down. Now you need to look at the market, the current market as it exists for across these opportunity sets, and look at the incumbents or the competition. So we did a deep dive and a study of the current market across the retail space and the institutional space, and the competition that is out there. And then, of course, you go one step down and you look at the regulatory framework, or as it exists today, and as it is bound to change over the next couple of years. When we started this journey a year ago, of course, the elections had not happened, but we had, we were focused on what we had to do, right? So with all of this assessment and analysis done, we started the foundational build. And that foundational build is very important, right? So as you're entering a regulated space, for us, that foundational build included building the right pillars of controls. So we built a robust compliance framework. It took us some time to sort of really build it out. We have now nearly 500 people in compliance globally.
How many total employees globally?
Total employees around 5,500 globally.
And how many in the US?
In the US, we have just over 500.
Oh, wow. Okay, so we'll get back to
that. I wanted to say this before. Any build, I guess, the scale of that build is dependent on the size of the problem set that you're looking at, right? And of course, how we want to approach that problem set. So for us, this was an ever-expanding market here in the US, and it is a top priority for us to build out here in the US. So doing it right is very important, which is why that foundational build, before we even think about the product, which is ensconced in all of these other layers, right, is we have to think about the foundational build. So compliance, like I said, over 500 people in compliance with state-of-the-art processes, systems in place to navigate through all of the compliance requirements that we have.
And to a VC, knowing that 10% of your employees have to be in compliance, it scares us. But it's not unusual, honestly, for exchanges. Let me just ask Sun, tell us a little bit about your journey. You're, I think, the youngest of the 3 companies up here. So where did you decide to domicile, and which markets do you offer the product in?
Yeah, so Veda is actually a remote-first company. I wouldn't say we have any particularly interesting story. We do have US employees. We also have non-US employees. But from a product perspective, we have taken great pains to avoid distributing our products to US people. We're actually an infrastructure provider, so we don't operate the interface, the user interface, but in spite of that, we've still gone to those lengths. Obviously, with the current administration and we're seeing a lot of companies become a little more aggressive with their strategy. We've started to think about it, but yeah, that's kind of our perspective.
If you guys were going to start a new crypto company today, would you have concerns about focusing on the US as one of your first markets?
I'd say it really depends what you're doing. We have definitely seen a diversified set of products that are starting to be rolled out to US people, including DeFi products, right? The first thing is like staking is kind of this thing that's been around for a long time, and it's like basically not a security. So the more your product experience matches something like staking, the more comfortable people are offering it to the US. We recently saw Coinbase roll out Bitcoin-backed loans, which they made available to US. But as you get to more complex DeFi products, it becomes trickier and trickier, right? These are obviously gray areas, and the regulation has not caught up yet. So I'd say it really depends. In DeFi, it's very tricky.
You guys, what would you answer a new startup, should they build in the US?
I mean, certainly serving the US market, if you can, you should. It's a huge, it's the largest market. And at the population level, it's super crypto friendly. It's a great market to go after. I still don't think I would domicile in the US today. I still think there's too much regulatory uncertainty. Who knows what happens in, what is it now, 3 years, I guess, when things change over. So I still probably wouldn't domicile in the US, but to the extent that you can serve the US market, I think that's great.
What do you think, Roshan?
I would beg to differ, actually. I'm pretty gung-ho about the US, and the reason why we are focusing on the US and we are prioritizing US is because I think the winds of change are really visible and blowing well. Yeah. One has to take advantage of those tailwinds when it comes. I also think that the mindset, the public mindset, is considerably changed as well. It's not just about the legislative framework changing and positive regulations being in the pipeline. That is, of course, important. But I think there's the public mindset towards crypto and digital assets in general has also changed, and I would say startups, even if you're bootstrapping, you should take advantage of that.
Great. Well, let's talk about decentralized finance a little bit more broadly and what you guys think is happening. We'll try to center the conversation a little bit on the US, since that's the point of the panel. So we've got stablecoins at $250 billion on chain, $27 trillion of stablecoin transactions last year, more than all of Visa and MasterCard combined. But we're still talking about it like this is emerging, it's about to happen. We have a bill, hopefully, that becomes law so that we don't have to worry as much, Mike, about who's president 3 years from now. And so it does feel like, even to the skeptical, that we're hitting an inflection point, likely to hit an inflection point in blockchain usage, if just for stablecoin transactions and usage, right? And so that's going to get a whole bunch of wealth on chain. In addition, we have increased every day a little bit more interest in owning digital assets that are not just stables, like Bitcoin, ETH, and Solana, as expressed through the ETFs, the digital asset treasury companies, of course, right, showing a lot of interest, and then just raw purchases. Maybe market structure bill makes that into law as well. Now it's really clear what's security, what's not. So I don't know. Just it feels like the table is set for significant increased adoption, and once you get stables and more digital asset ownership, the first question, or you should be asking yourself, is how do I make those things productive, right? Like, what do I do with them? So what's missing in the market today as the answer for that? I don't know, Mike, Sun, grab it.
Well, I mean, this is certainly an area that we're working on, how to make DeFi easy and accessible to users. I mean, there's so much that's missing. The experience of using DeFi, how many people have used DeFi here? Okay, most people actually. All right, so you know what I'm talking about. I mean, it's insane, right? Like, you have to download this, friggin' browser extension, create a wallet with some random words and seed phrase. You sign random hex text, then if you sign the wrong one, all your money's gone. It's absolutely insane. Not usable by any normal person. I'm sure many people here have had the experience of trying to explain to a friend who was interested and wanted to use DeFi, and you have the back and forth text messages for multiple days explaining to them how to buy stables and put it into MetaMask and then put it into Aave, and you get an A token. Again, the whole thing is crazy. So that stuff needs to be fixed. I mean, that stuff just needs to be abstracted away. I mean, I'm not saying anything new, but like the people actually have to do this, where you get all the benefits of self-custody, you get the nice advantages of being plugged into DeFi and the high yields and all the things that we know and love, but in a structure and form that is actually accessible to normal people. And then the second piece that's missing, among many other pieces, is we need more productive assets on chain. Right now, there's an infinite, variety of speculative assets on chain, but hardly any productive assets. I mean, we have T-bills. I guess that's sort of a productive asset. You're loaning money to the government. I guess it's better than nothing. But what we need is more, RWAs, productive assets on chain.
So sorry, one question though. So an asset that is stakeable, that brings you yield or rewards, you don't consider a productive asset in that definition?
Well, but where does the yield come from?
Well, in the
gambling.
I mean, you know where it comes from, right?
Yeah, gambling. It's all, you have multiple sort of turtles all the way down. But at the end of it is speculative premium on ETH, BTC, whatever. That's ultimately where the staking yield comes from, why it's worth anything. That's fine. As a bootstrapping mechanism, that's fine. But at some point, people have to do useful things.
Yeah, so that's what you mean by we need more productive assets on chain. But what about just for proof of stake blockchains where there needs to be a fee to use the chain? Won't we reach a point for some assets where the fee to use the chain is the source of the yield?
For sure, but the question is, what are you doing on? This is what I mean when I say the staking yield is really just indirect gambling revenues, because what are people doing on chain? I mean, 90% of it is gambling. I don't know how. Maybe it's 80%, maybe it's 70%, but like majority of it is speculative. So the question is, at some point, when does that flip? I mean, if you look at casinos as part of the global economy, it's a large market, but I mean, it really is kind of a rounding error on the global, productive output. When the gambling stuff becomes a rounding error in crypto, that's when that's why I guess many of us hopefully believe ETH and other proof of stake chains are going to become super valuable, because like you're going to have a 100x, 1000x increase in productive activity on chain.
What was one argument is that the catalyst for that massive increase in usage is stable transfers, right? Is the use of stables.
For sure, yeah.
Sun, tell us a little bit about this sort of thought about. Do you buy my logic chain that or logic train? That we've got these sort of carpet laid out in front of us about what's about to happen, and it leads to more DeFi usage?
Yeah, absolutely. I think Bitcoin, stablecoins, and RWAs are really going to be the three areas that we're going to see the most growth, and that's downstream of that is getting assets productive on-chain and creating sustainable fees. I definitely agree with Mike that most of what's happening on-chain, especially when you look at revenue, right? Recently, there's been this debate, I mean, not recently, but Solana versus ETH, right? What's more economically sustainable? ETH generates like no fees anymore, and Solana generates a ton of fees, but where do those fees come from? It's from meme coin trading, right? Which is certainly not a sustainable source of revenue. But I do, my maybe not so controversial opinion is that degens actually are providing a real public good and service to humanity in the sense that all of this infrastructure needs to be battle tested, right? Before it's ready to process and settle trillions on chain, you need that marginal risk taker who's going to go in there, put their own capital at stake, and test these systems to make sure that they function properly. And I think now, for the first time, maybe over the last 6 months, we're finally there, right? These systems have been battle tested over the last 4 years or so, and they work at scale, right? And so we are truly at that inflection point, and we can see it with the caliber of company and distribution that's starting to offer DeFi products. Again, the Coinbases of the world, so centralized exchanges are first, but we're also seeing interest from large fintechs like Revolut, Robinhood. Traditional asset managers, traditional institutions are a little bit farther down the line, but they're also interested in this stuff. So I definitely think we're at that inflection point, and DeFi is gambling today, but the stage is very much set for global adoption.
Let's ask a centralized exchange. So tell us a little bit about what DeFi-like products or features are available to OKX users.
Yes, we recently launched Earn. This was last week. So we launched Earn across 9 chains, and we'll launch across 3 more chains either this week or next week. So that's sort of like our a foray into this in the US right now. Of course, as the future unfolds, we see more and more products that we will launch in this space as well. Having said that, OKX also has a Web3 side to it, right? And talking about adoption, what we're seeing with the data that we have from Web3 wallet, the adoption has been tremendous, and from 0 to up to nearly 2 million customers' daily average usage of our Web3 wallet service around the world. That's a tremendous upscaling that we are seeing in the space, and that is a positive message to folks out there building in the space.
For all 3 of you, for the next 2 years, do you expect more usage and adoption incrementally from where we are today coming from retail and consumers or institutions?
So there's this kind of irony, I think, where you might assume, institutions are like less risk-seeking, right? They're more risk-averse. They want safer products. But I think for the people that are using DeFi today, it's largely liquid funds, DeFi funds, yield funds who are more institutional, and then degens who are, like sophisticated, right? So to some extent, you could argue like retail's not here. It's actually more institutional, but it's a very specific kind of institution. I think the next wave of adoption we'll see is going to be more retail focused. So these are users who are on exchanges, who are on wallets, who never actually touched DeFi, but they've traded majors like Bitcoin. And as exchanges integrate DeFi more seamlessly into the app experience, these users will be using DeFi. Beyond that, right, and then of course we get into fintechs. Beyond that, I think we'll start to see institutional adoption of DeFi a little bit after that, ironically. So yeah, it's pretty exciting.
So I actually think it's going to continue what we're seeing today. And what we see today is the vast majority of users, kind of numerically, are of course retail users. But the vast majority of capital comes from institutions. And that's even what we see at EtherFi. I mean, there's a huge number of wallets and users and people that interact with EtherFi. But if you look at where a large percentage of the capital, vast majority of the capital is coming from, it is institutions. So I think we're going to see both scale. I think we'll see crypto, on-chain crypto, DeFi, which today is, I don't know, low single-digit millions of users, probably. Scale probably to tens and even hundreds of millions of users once the DeFi and bubble wrap sort of frameworks come about. And then similarly, we'll see institutions deploying, now they're deploying tens, hundreds of billions starting to scale up to trillions once real world assets, equities, et cetera, more interesting kind of bonds make it on chain.
Do you agree?
Yes, and I'll just support it with some data from our research as well. So which prior to launching, we did some extensive market analysis and assessments of what we should be doing and how we should be doing it. So and the U.S. is a microcosm of the rest of the world in many ways. So if you just look at the U.S., you have around 250 million people, out of which around 50 to 60 million people actually sort of have touched crypto. And then you have 100, 110, 120 million people who have really, who are under the crypto curious bucket, right? And it's interesting, as we haven't yet started to turn on our booster rockets, which is turn on our marketing and branding engines, but we are starting to do that. And I'm seeing some interesting data come in the centralized exchange side, right? So you can segment the retail customers who are coming in into around 10 to 12 different buckets, right? And you can market different products to them based on that. On the institutional side, interestingly, of course, there's what we call as our high-touch institutional customers, who are your hedge funds, your proprietary trading groups, and your other large institutional asset managers, et cetera. But I also see another group which I've bucketed under low-touch institutional customers, which are small and mid-sized merchants, for example, right, who are coming in. And that's an interesting use case as well, especially when over time we want to get into that intersection of payments and stablecoins.
Okay, in the 2 minutes we have left, each of you gets to please offer one point of view about what's going to happen in crypto that most people in this room will disagree with. You have 10 seconds to think.
Sorry, I didn't get that.
Please offer one point of view about what's going to happen in crypto that most people in this room will disagree with.
I'll say something. I don't even know if I believe this, but it's a thought I've had. I'm not convinced stablecoins is going to be such a great business. I think eventually margins go to zero. It becomes completely undifferentiated. There may be thousands of them. There may be one or two, but I don't think they actually generate any revenue, any underlying revenue. So I think we'll have trillions and trillions of dollars of stablecoins. But if anything, it'll actually reduce the profitability of the finance sector, because right now, if you look at how much money do banks generate by taking your deposits and putting it into all kinds of exotic gambly stuff, including T-Bows, a lot. That's a lot of their revenue, and the kind of like all of that revenue just goes away when stablecoins become ubiquitous.
Good one, son.
My hot take is that the price of ETH is going to go up for the next year, probably. No, but
maybe that ETH's going to become super competitive, move very quickly, and add lots of features.
That's another hot take. Yeah, I think to Mike's point on this point of value capture, I don't know if I believe this either, but there's an argument that all of DeFi primitives, the margins just go to zero, right? Like when the infrastructure is open, ubiquitous, there's zero switching costs. Liquidity and network effects are debatable. We've seen that repeatedly, that this will be really good for humanity, and all of the value, instead of sticking with, this was the vision of crypto, right? Instead of staying with any intermediaries, it just goes back to humans. AI is going to play a role with that. So yeah, basically DeFi is just not going to be very profitable, but we'll see. I don't know if I believe that, but who knows?
Close us out.
I'll go on a limb and say, well, you'll see over the next probably 5 to 10 years an array of distributed marketplaces emerging, selling financial products on chain, which is sort of like the Amazons of financial products being sold on marketplaces on chain, and that'll require, and there will be a few winners emerging there, right? And those winners will be the ones who build with the right kind of foundations.
Awesome. Thank you, everybody. Thanks for coming, and big thanks to Blockworks for having us here. Love you guys, and thanks to this awesome panel.
Thank you, everyone.